Alright, you guys, we'll start back with exercise 2-8 on page 97. We'll begin again with number 4. Let's read through it. On November 1st, 2016, the company borrowed $200,000 from a bank. The note requires principal and interest at 12% to be paid on April 30th, 2017. So what they're saying here is on April 30th, 2017, the bank is going to want the $200,000 back plus interest at 12%. And the thing about that 12%, you guys, that's an annual rate. It's 12% for a year. This loan is only for, what, 2 months in 2016 and 4 in 2017, so it's only a 6-month note in total. And that 12% is 12% for a year. Okay, now we're at December 31st, 2016, their financial statement date. So we want to record any expenses, update the accounts, of course, with these adjusting entries, record any expenses, liabilities, assets, any accounts that need to be on the books that are not currently on the books. So what we're going to have here from November 1st, 2016 to December 31st, 2016, some interest is built up on this note. Now, since they're the borrower, it'll be interest expense. And they haven't paid them yet. Interest expense is an expense that's going to increase. All right, so let's figure out the amount. Let's go to our calculations here. All right, interest expense for November and December 2016. That's all we're interested in calculating because we want to know how much interest they owed on the note as of December 31st, 2016. So the first thing I want to know is how many months are we talking about? So I'm going to say here it's equal to, okay, we got the month of November and December. So 2 months divided by 12 months in the year. This gives us the percentage or the amount of the year covered by the note in 2016. So 2 months out of 12 months, November and December, fell in 2016. So that's almost 17%, but we'll just use this number in our calculation. So when we're calculating our interest expense for these 2 months, we want to say $200,000, the principal amount, times the interest rate of 0.12, times the period of time covered by the note, 2 over 12, or I'm just going to say this, 0.16666. Finally, they put a 7 on the end. All right, now if we hit enter, and that's, again, the principal amount, $200,000, times 0.12, the interest rate, times the period of time covered by the note. And we got that by dividing 2 months by 12 months in the year. So that comes out to $4,000. So that's $4,000 of interest expense built up in November and December on this note. That's an increase to our interest expense account. We do that with a debit. Now, we're not paying them the interest on December 31st. If so, we would credit cash. We're going to pay them the interest when we pay back the principal on April 30th. But we do owe that interest as of December 31st. So we're going to credit a liability account, interest payable, to get that liability on the books. Liabilities increase on the credit side, $4,000. Okay, number 5. On December 31st, 2016, the company received $3,000 in cash from another company that is renting office space in Faldwell's building. The payment representing rent for December and January was credited to deferred rent revenue. You might have seen that in other courses as unearned rent. They're calling it here deferred rent revenue. In financial accounting, we just called it unearned rent. That's 2 different names for the same account. Deferred rent revenue or unearned revenue. Or excuse me, unearned rent and deferred rent revenue are 2 names for the same account. Okay, so what happened on, let's go back And on December 1st, let's look at the entry that they made. Okay, on December 1st, they received the $3,000 in cash. They increased their cash account by $3,000. And they credited deferred rent revenue. For $3,000. Now that's a liability account, increases on the credit side. Of course, cash is an asset that increases on the debit side. Now they put it in this liability account. It creates a liability on December 1st because we can't record it as a revenue unless we've earned it yet. Well, they paid us rent for December and January. We haven't earned any of it on December 1st. But by December 31st, for our 5th adjusting entry, we have earned a part of it. We've earned half of it, right? So our liability deferred rent revenue decreased. Liabilities decrease on the debit side. How much of it have we earned? Well, if it's $3,000 for 2 months, and we've earned one so far, per month it would be $1,500, and we've earned 1 month so far, right? That's rent per month, $1,500. The $3,000 was for 2 months. We divided that by 2 to get rent per month. Well, here only 1 month has passed off from the day the payment was received to the end of the year. So we'd make the entry for 1 month's rent. If we had received 3 months' rent on November 1st, then we'd be making this entry for $3,000, right? Or if on October 1st we had received 4 months' rent, we'd be making this entry for $4,500. I hope that makes sense. Here our liability deferred rent revenue decreased because that revenue is no longer deferred. We've now earned it by December 31st, right? So now that it's been earned, it can be placed in the rent revenue account. So revenue account increases on the credit side. So this one is actually not a part of the problem. We can leave it in there anyway. That's just what happened. To me, it makes it easier to make the adjusting entry if you look at what happened on December 1st. Now, once we make this adjusting entry, that leaves our balance in deferred rent revenue at $1,500. That's the amount of rent we haven't earned yet, the part that's for January. And it makes our balance in rent revenue $1,500 for the portion that we earned in the month of December. Okay, you guys, you shouldn't have any trouble now doing exercise 2-8 on the Connect Plus site. If you have any questions, please give me a call at 828-593-0459, or you can reach me via email, jweatherford, and that's WEATHERFORD at haywood.edu. Last name is I say Weatherford, but it's like weather and then forward. The 2 words just jammed together. I'm sure you know that by now. But please be in touch if I can help you. And good luck.